We've got most people are in. There's still a couple more, so I think we'll start this session off. I know we've got quite a bit to get through. You're all very welcome today. I'm Brian Farrell, CEO of the County Carlow Chamber of Commerce, and delighted to welcome you for today's webinar, which is Finance Options and Supports for the Business Community in Carlow. So this is the first of Lunch and Learn series in conjunction with the Carlow Local Enterprise Office and IT Carlow. Today's presentation will be delivered by Tony Harney of Harney, Nolan Chartered Accountants and John Madigan of the Strategic Banking Corporation of Ireland. Just to let you know that we are recording the series as well, and it will be available for playback later on the Chamber website. And if you have any questions at any stage, you can pop them in as we're going along on the chat function, or we will take some time at the very end to run through our questions and answers, and you'll be able to unmute at that stage then as well. So I'd now like to hand you over to Kieran for some words from Kieran from the Local Enterprise Office.
Thanks very much, Brian. I might ask everyone just to turn on your cameras for a second if you do have a camera, because I'd like to make a point, and I think it's important that we can see everybody, and don't be shy. See some faces popping up there. While you do that, I'll just a few words, I suppose, and firstly, just to welcome you all to Brian. Delighted to be working with the Chamber and IT Carlow on this series of Lunch and Learn events. I think we're nearly a year into lockdown, the various things at present. It'll come up on it very quickly. And ultimately, people do business with people, not with a screen. And I think that's what our focus is very much on for 2021, that behind every screen and behind every box we see every day, there is people, they're doing business, they're trying to do their best. There's very challenging conditions out there. And ultimately, the only way we can get through this is by all working together and remembering that there's faces at the end of screens. And I think we're all suffering from Zoom's fatigue at the moment and Teams fatigue. And I think it's really important that we take a moment and opportunity through the Chamber and through IT Carlow and through ourselves just to reach out to each other in the context of supporting each other. And the idea and the genesis of these four, there will be a fifth one scheduled, Lunch and Learn events, is firstly to get people, to make sure that there's a network out there, and the Chamber do fantastic work, obviously bringing that network together on an ongoing basis, and to just realise that we're all going through a challenge, whether you're in the public sector, whether you're in a community group, whether you're a business, everyone has a challenge at the moment, everyone has uncertainty, and it is around reaching out to the people in Carlow. The other thing then is the four series are designed to give you information. So one of the things we often hear in our line of work is that there's lots of supports out there, but how do I access the right one for me? So this week we're starting with the Tony and his independent view on it, and I think it's really important we'll start with an independent view, and John as well from Strategic Banking. John doesn't directly provide services to the public, he does it through different bodies and agencies, and really important information both of them have. Next week we'll move on to Enterprise Ireland and ourselves, so Brian Fives and myself from Enterprise Ireland will do a presentation, and then we move on to the IT, and it is twofold. It is about information about people. So I suppose we would encourage people to interact as much as possible on this and reach out during these times in the context of it. And don't forget, there is a network out there. One feedback I'm getting a lot from people currently is the human aspect. It's all becoming very transactional. So don't forget the human aspect. Like when we started off this, and I don't mean to joke in a positive way, Colin was calling out the lunch menu in the Woodford Dolmen. I'm sure Michael Walsh has one. He happen to be head under each other at the moment. But, people are forgetting that in the current climate. So do take the opportunity to say there is a network of people out there. We'll share the notes and obviously do that. We're delighted to support you in whatever way we can going forward. Obviously, there's been a few government announcements over the last few weeks and new supports. Once you digest that, we'll feed that back to you. One of the particular ones is the whole thing about the rates rebate for this year and how it's working for the first 3 months. So we'll have information on that by next week's session. So I'm not going to take up any more time. As I said, my key message is don't forget there's a human network in Carlow of people who want to help each other. Do reach out to them. There's been fantastic examples across the county of people working together, and the same thing from our viewpoint. The support network is there in the local enterprise office and also from IT Carlow. So thanks, Brian, for the introduction. Delighted to be working with yourself and Colin. And just finally, the likes of myself and Colin don't put together these activities. It's a team of people behind it. So obviously Brian in the Chamber and Pauline and Leo and Brian Ogilvie in IT Carlow. So thanks them for putting them all together, and that's enough for me. So thanks very much, folks, and enjoy the session.
Thanks very much, Kieran. Appreciate that. And now I'm going to hand the floor over to Tony Harney. Tony is going to take us through a range of different financial measures and supports, including wage, payroll supports, CRSS, VAT, duties, and maybe even some more that we haven't even heard of yet. So Tony, I'll hand it over to you.
Okay, Brian, I should be able to share my screen. That's the idea.
Yeah.
People can see my screen there.
We can.
Okay. Okay. I'd like to say thank you to Brian from Chamber and Kieran from Local Enterprise Office for hosting this. Okay, hold on a second now. I need to get this moving.
It hasn't moved there yet. Ah, there we go.
It has now. Okay. Okay. I also want to say hello to my co-presenter, John Madigan of SBCI. Not many of you may know, or many of you may know, that John and I are good mates outside of this platform. So times are so odd that I have to come to this platform to see him. So hello, John. So I've been asked to talk about the COVID supports for SMEs as things stand now in mid-February 2021. And I'll talk about them in terms of income supports, the revenue aspect, touch a little on other supports. And if I have time left at the end, I'll talk about Brexit and VAT and duty and all that good stuff. It's the COVID supports, I mean, they fall very much into our bailiwick, as in your accountant, because in obviously, and we all know at this stage that revenue have been given the job of handling these supports, and I see it in many ways as negative taxation. I've spent a lifetime computing taxes, sending money into revenue for clients. Now the traffic is in the other direction. I'm going to speak initially about the income supports being the temporary wage support scheme, which we called the TWIS. You'll wonder why I'm still talking about that, because you'll ask, did that not finish back last August? I'll speak then about the current employment wage subsidy scheme, the EWSS. I'll talk about the COVID restriction support scheme, the CRSS, and I'll talk about a new one announced only last week, the COVID-19 Business Aid Scheme. We shorten it to CBAS. The reason I'm touching on the TWIS, which because there's still some unfinished business there. There are outstanding issues from both the employer and employees' perspective. From an employer perspective, I would imagine virtually every employer owes a few bob back to revenue. So there's a process of reconciliation and the refund of their overpayment. Typically won't be huge, but it's still out there. And very significantly for employees, every employee who was paid or partially paid by the subsidy scheme will have got a tax bill from certainly a tax reconciliation from the taxman last month, very likely resulting in a tax liability. And I'm going to touch on that and touch on it from an employer's perspective and ask the question, can the employer pick up the tab if the employer is in a position to do so and so wishes? In terms of the reconciliation piece, from the employer's perspective, the process involved from March to end August, claiming the subsidy, paying it out to employees. Then there was a piece where towards the end of that time, Revenue came along to employers and said, well, please satisfy us that you are actually eligible for the scheme. And they promised at the time that they would reach on every employer who availed of the scheme, which I think was about 55,000 employers. I thought it was a bit brave of them, but it's been my experience that they did get around to everybody. A little piece of it then was at the end of October, every employer had an obligation to report to Revenue the amount of subsidy they had drawn down and paid out to the employees. And in a sense, that was only giving them information they already had, but there was an obligation to do that. And that fed into two things. That fed into the tax calculation for employees, but it also fed into this reconciliation thing, which is pretty simple maths. There's the question that there's the amount of subsidy an employer drew down, or sorry, claimed, and then there's the amount actually paid out by government. And in the early days, you may recall that they paid out €416 per week to every employee, irrespective of the amount involved. So typically an employer was overpaid and has typically, well, in my experience, in all cases, has yet to pay back that money. I asked a question a moment ago as to whether an employer, if the employer so wished, could pick up the tab, the tax bill for an employee. You'll be aware that the subsidy in the hands of the employee was a taxable source of income, but was not subject to POE in the normal way. So the Revenue came along and last month landed a tax bill on employees in this regard. Those tax bills would range from zero tax, depending on circumstances, up to 3,300. I'll look here for a moment, just take a sample liability of €2,500. If the employee, so the employee has, it is in the first instance the employee's liability. If the employee has the funds, he or she can pay that in one lump now. If he or she does nothing about it, it will be collected by reduction of that person's tax credits out over 4 years to December 25. So in other words, the years 22, 23, 24, and 25. So an employee with a €2,500 tax bill will be paying that at €52 a month by deduction out till December 2025. And if the employer considers paying, if benefit in kind were to apply to that, think of it like this. If an employer needs to put $2,500 into an employee's pocket, in principle, in normal circumstances, it's going to be taxed, say, at 50p in the pound. So it's going to cost $5,000 to the employer in the first instance to give $2,500 to the employee, and another 11% in terms of employer's PSI. So it would cost the employer €5,550 in my example to put €2,500 into the hands of the employee to pay the tax bill arising on the TWIS. But the taxman came out, Revenue came out early December, I think, and said, well, if the employer wishes to do this, we won't charge benefit in kind. So the employer can go on directly onto the system and pay an additional €2,500 for that employee, and there will be, it won't be worse than that. A pity they put one little sting in the tail. They said, since we're giving you that benefit, that we're not charging you benefit in kind tax on it, they said, we will not in turn give you tax relief on this. So if an employer paid that $2,500 for the employer would rightly consider it to be part of his wages cost. But the taxman says, you won't get tax deduction on it. We're giving you enough by not applying the BIK. So to a company, the denial of that 12.5% tax relief would amount to €312.50 of a tax cost to the company. In the case of a sole trader who at the extreme end, and I can think of, say, solicitor clients who would be paying tax at 55% marginal rate, the denial of that tax relief would amount to €1,375, not at all insignificant. If the employer, despite that little denial, chose to pick up this tab for the employee, it must be done before 30th June next. Before I leave it, I'll comment that my door is not being knocked down by employers looking for details of this. The employers who are inclined to pick up this tab for the employees are in the minority. And that would be the experience of my colleagues outside this practice as well. I'll talk now about something more current, being the current employee wage subsidy scheme. You're likely, if it applies to you, you're likely familiar with it. It involves a subsidy of €350 per week on a gross wage that is above €400 per week, and it reduces below that to €151. In addition to that subsidy, the employer does not pay normal employer's PRSI of 11%, but pays instead employer's PRSI of only 0.5%. So if I take an example, a sample wage of €600 per week, the cost to the employer in normal circumstances would be 600 plus the 11% would be 666, a devilish kind of number. But with the benefit of the subsidy, the cost is 600 minus the 350 subsidy plus 0.5% PRSI, which is only €3. So it's a cost to the employer of €253. The benefit to the employer is €413. It's far cleaner than the TWIS was because it has no impact on the employee. In fact, an employer could be claiming the subsidy, and an employee mightn't know. So it will, and it's cleaner in the sense it will have no impact on the employee's tax down the line and so on. So the big question is eligibility. Are you eligible or not? The very first thing we did when we came back after Christmas was we communicated with clients and we said, okay, there's a lockdown coming, and we probably wouldn't have known how serious and how long the lockdown would be. But with a little bit of foresight or pessimism, we said to clients if you're not claiming EWSS and if you're not claiming CRSS, consider again whether it might apply to you in these in the coming lockdown. And I'm at this stage, I'm glad we did that. It applies to be eligible. You need to be able to project a 30% reduction in either your turnover or your orders. Now, turnover, in my experience, is the more typical test. Orders is relevant where there's a gap between the placing of the order and the conducting of the business. At the extreme end, the really, really extreme end, and I know Boeing are not on this webinar, but you can imagine Boeing continuing to make planes that were ordered a long time ago, but getting no orders in these current times. So their business would be mightily impacted. Might be an extreme example, but hopefully drive home the point. The reference period is the first 6 months of 2021 compared to the first 6 months of 2019. No point comparing against 2020 because the first 6 months was already impacted by COVID. The difficulty for any business considering whether they're eligible or not is that by the time you get to July 2021, you'll have the benefit of hindsight and you know whether you did qualify or not. But the difficulty is you've got to do your projections now. And if you came into this year thinking, well, the back end of 2020 was all right when we got out of the lockdown, I'd be saying to people, don't be over optimistic about this. I'd be saying you don't really know. Like January was dark, February was dark. It's likely that the lockdown will continue to be severe and elongated. So in general, I say to businesses, don't be over optimistic about your projections. Review at the end of if you do go for it, review at the end of each month. And if it's clear that you're not 30% down, step out at that stage. I say step out when appropriate. now I'll talk about the CRSS. The CRSS is separate from the wage subsidy, can indeed be in addition to the wage subsidy. So a business might be eligible for neither or for both. It puts money in the pocket of businesses that are closed or almost closed due to the restrictions. Think that it's intended to put money into the pocket of a business that inevitably has overheads, even though their business is decimated, or far worse than decimated. So think hairdressers, pubs, restaurants, travel agents, they would all qualify for it. The payment is paid per week of lockdown. So we're currently in a scenario where the entire country is locked down. But there was a time some months ago when you'll recall that Laois, Offaly and Kildare were locked down. So in that period, businesses in those counties could avail of this at a time when business outside those three counties could not. It's quantified at 10% of turnover up to on the first million of annual turnover, and 5% thereafter. There's a ceiling of 5,000 per week. And I'll give you a simple example. If you have a pub doing 750,000 per annum, 10% of that is 75,000, and that on a weekly basis is 1,442. So such a business puts out their hand for the CRSS and gets 1,442 euro per week from revenue. I've noticed that it's a little bit crude, but naturally all of these things are crude because they're made up on the hoof, and it favors businesses with high turnover and low margin. So if your business model is based on, so I could have a business model based on just selling services, buying in no goods. I might have a modest turnover but making a decent income. You could be making the same income, but from a business with a high turnover and low margin, and insofar as it's based on turnover, it'll favor the business with the high turnover. It's just an inevitable consequence of the way it's structured. Eligibility for this, you've got to have a taxable trade, so that immediately eliminates charities and so on. You got to, so if you've got a trading income, you're going to pay tax. You've got to be trading from a premises located within a restricted area. Well, I touched on that a moment ago, but the idea is that you have a premises. It's not intended to pick up businesses trading from your back bedroom. And the public are restricted from entering that premises. Think, as it was designed, think a high street business. I said a moment ago that your business has to be decimated. I think the term decimation comes from losing 1 in 10 of your army. This is much worse than this. You've got to be you've got to lose 3/4 of your turnover or more. And the reference period is your average weekly turnover in 2019. There's a new scheme announced only a week ago. I don't have the entire flesh on it, but I think that's because the entire flesh isn't out there. It was announced only a week ago. It's aimed at businesses who missed out on the CRSS. And the way I understand it is that the CRSS, they thought initially of businesses on the high street that were trading with the public, but were thereby restricted from trading with the public. So whereas the CRSS was aimed towards retailers on the high street, think of this one being aimed at wholesalers and caterers and events companies. An example, if you're a supplier into the ploughing championship or you're a supplier into electric picnic, the way I would see it is that CRSS is aimed at the high street and this one is aimed at the industrial estate. The eligibility for this one, you need to have a turnover in excess of 50,000. You need to be not owned by a public body. You still need to have a premises. So selling from your back bedroom isn't going to work. You have to have a rates bill. So at that level, that kind of fastens my understanding that it's if it's not the high street, in this instance, it's the industrial estate. Otherwise, I think it's going to operate like the CRSS. Interesting one in that businesses who might have given up on the CRSS as not being fitting their circumstances, this one might indeed. Okay, those are the main direct financial subsidies. I'll touch on now for a moment on tax warehousing, so that for SMEs, which is in this instance businesses with turnover below 3 million, we're in that funny world where businesses don't have to pay their taxes, or put it this way, if they don't pay their taxes, the consequences are not what they otherwise would have been. So you can defer paying your taxes, and you can what taxes can you defer? You can defer paying your employer's PAYE, you can defer your VAT, you can defer your self-assessed income tax, the income tax you would have dealt with your accountant last October, November, being the balance of 2019 tax and preliminary tax 2020. And you can also defer paying the balance of your wage subsidy, one that I touched on some moments ago. So what are the consequences of not paying your tax in this situation? Well, for the first year, there is no interest, so there is no consequence. After that, when you get to the end of that year, you'll be expected to enter into an agreed phased payment arrangement with revenue, and the interest rate applying will be 3%. Remember that normal rates on late payment of tax are 8% in respect of income tax and 10% in respect of POE and VAT. The difference being, and this is there for years and years, income tax is tax on your own income. POE and VAT is taxes you collect on behalf of the government. They call them fiduciary taxes, and they hit you even harder if you don't pay those taxes over and on time. And the other thing, if yours is a business that needs tax clearance cert for whatever reason, there are no negative implications for your tax clearance cert if you avail of tax warehousing and do not pay your tax. Touch on rates for a second. The little bit I know about it, I hope I'm up to date. Last year, rates were the basis for the restart grants. In addition, there was a waiver of rates for all of us from April to December 2020 across the board. It's my understanding that for 2021, the waiver will be more targeted at businesses most hard hit. So hospitality, leisure and retail and so on, that the waiver will not be across the board. I'm running on in time. I'll try and breeze through this as quickly as possible. Brexit, VAT and duty. And just remind people, if they're running into problems, just remind them of some of the basic principles. Any importer and exporter will know that there's new cost and bother associated with importing and exporting. Bother in terms of additional paperwork, in terms of additional checks and phytosanitary checks and cleaning of this, that and the other. And that's not really my bailiwick. VAT is the one that crosses my desk. Duty to a lesser extent. VAT for VAT registered businesses should not be a cost. So duty is the one that, if it arises, is a cost, is a measurable dead cost. Duty, so we'll understand that the Boris deal at the end of last year is in effect a free trade agreement. So you'd wonder, so why might duty apply? Well, duty is based on rules of origin. So if you're importing product originating in the UK or the EU, it's duty free. But if the product that you're bringing in originates outside the UK or outside the EU, it is subject to duty. And so, for example, a UK supplier supplies goods made in China into Ireland, duty is payable at the point of import. That duty is based on tariff classification on the particular goods. It's represented as an 8-digit code in what's called the combined nomenclature. If it were printed as a book, it probably wouldn't fit in my office. You are entitled to challenge the classification. We had an example last year of somebody importing stuff from China, and when they started importing, they were hit with a 6.7% duty. And we challenged it, took it to revenue and said that the goods were wrongly classified. And if they were classified correctly, no duty would apply. And we won our argument. We got what's called a BTI, a binding tariff indication. And so no duty applied. And you know, thankfully, we're able to add 6.7% to the trading margin. VAT at import. So, since the UK is outside the EU, in principle, VAT applies at the point of import. VAT applied at the point of import for imports from outside the EU for decades at this stage. There was always in place a deferred payment scheme. It had fairly limited application. In my experience, was for fairly heavy hitters. It applied to both VAT and duty. You didn't have to pay the VAT and the duty until the 15th of the following month. But to be able to avail of it, you needed to be strong enough that your bank would give a guarantee to revenue that the VAT and duty would be paid by the 15th of the next month. So it was akin to having another bank facility. As I say, doesn't have major application, in my experience, to SMEs. I'm going to touch on the notion of postponed accounting, because this is really where the change is at. I outlined the principle that VAT applies at point of import, but in practice, the government recognized that if every importer had to pay VAT on all goods coming in from outside the EU, including the UK, that it would be a big burden. So they introduced, with effect from 1st January 21, the notion of postponed accounting for VAT. It's for VAT only, doesn't apply to duty, and you get the deferral is until the postponement is until the next VAT return. And it's not just for imports from Great Britain, but for all imports from outside the EU. So when you avail of postponed accounting, which you will if you are VAT registered, the VAT is not paid at import. It's payable at the next VAT return, but typically it will be reclaimable. So if a business brings in a load of steel for €10,000 with VAT at 2,300 euro, there's no cash flow effect at that stage. What you will do is in the next VAT return, you say, oh, Mr. Taxman, I owe you the 2,300 on those imports. But in the next breath, and in the next line, you say, but of course, if I had paid it, it would be reclaimable. So I'm now reclaiming it. I'm acknowledging the liability, but I'm also reclaiming it. So a zero sum. It's available to all VAT registered traders. It can be withdrawn if your tax affairs are not in order. So if you're a naughty boy and you're importing and whoever's handling the import on your behalf quotes your VAT number and you come up as a naughty boy, at that point, you will not be entitled to the postponement. But for the vast majority who will have their tax affairs in order, the postponed accounting will operate. You obviously will need to have your EORI, your Economic Operators Registration and Identification. When it comes to completing your next VAT return, there is a new line on it there. I just took out an extract from the VAT 3 return, and you see that line there, postponed accounting, box PA1. So pay attention to that one in your January, February VAT return and thereafter. Just last issues on VAT and Brexit and so on. if you're exporting, this can work both ways. If you're exporting and to someone in the UK and they are, should I say, fussy, and they say, we want nothing to change, just supply us as you always did with a UK VAT number. It is possible to be both the exporter and the importer. So you could register for VAT in the UK, take possession of the goods in the UK, and charge UK VAT when you sell them on from that point. We have had the reverse of that, where we have advised a meat exporter from the UK selling into the supermarkets in this country. And so you can imagine the likes of Musgraves say to them, guys, we want to do business the way we always did business. We don't want the complication of any of these checks, duties, phytosanitary, this, that, or the other. That's all your problem. So the solution was that the UK company set up an Irish subsidiary which will take delivery of the goods. It in effect will be the importer, will handle all those complications, and will sell on to Musgraves. And from the perspective of Musgraves, the process is seamless. I could go into the whole area of distance selling, but I won't take time. By distance selling, I mean selling online. If you're selling from your website, and the last thing, it's an esoteric kind of point, really. Remember the deal, what I call Boris's deal. It's a deal, a free trade deal in respect of goods. It does not apply to services. So the sale of services to Northern Ireland is actually a sale outside the EU, strange as that may seem. My last point before I hand back to Brian, that there is a screenshot of our Harney Nolan app. If you haven't already done so, you could do worse than download it, something free from your local accountant. And you see their message center. We send to message center updates on this kind of stuff. So if you have any fear that you're missing out, download the app, and those messages will come to you automatically. So that's it. Thank you. I'll hand you back to Brian at that.
Thank you very much, Tony. Very interesting there, and indeed the app it is a great handy source of information on a lot of things. I'm going to hand you straight over now to John Madigan. I'm delighted to have John here with us from the Strategic Banking Corporation of Ireland. And John is going to take us through some of the products from their side and to discuss how you can avail of some of those measures and support. So John, it's over to you.
Great. Hopefully everybody can see that now.
Yeah.
Okay. All right. Well, look, I'll do a slightly abbreviated version just to keep everybody on time and make sure that Colin can get to his lunch at 1 o'clock. He's looking forward to his fish and chips, so we can't put too much in the way of that. So in terms of ourselves, just to give you a sense of what I want to try and cover today is a quick intro, just the business funding supports that are available, the COVID-19 specific ones. Tony has covered off on most of grants, loans and advisory and mentoring, and actually when Kieran mentioned at the beginning that he's going to have Enterprise Ireland and themselves on for a webinar next week, there is actually very little need for me to cover any of these particular supports, and then just to draw a few conclusions at the end. So in terms then of us, we were set up 6.5 years ago. We were owned by the Minister for Finance. We were brought to the market to do a couple of things, really to fix what they call market failures, which is where the private sector can't or won't intervene. So effectively, what we're trying to do is to bring down the price of borrowing, make access to finance easier for SMEs, and increase competition in the Irish credit market. And hopefully, as you go through the presentation, you'll see all three of those being addressed. So we do three things. We do lending, risk sharing, and we are actually a service provider as well. Lending effectively means for us is that we will give low-cost funding to, particularly at the moment, non-banks. Banks can have enough liquidity themselves and can borrow on the market at the same price as we can give them money. However, the smaller non-banks, the Capital Flows of this world, the Fexcos, the linked finances, they can't borrow the money on the market at the same rate as the pillar banks. So what we do is we actually give them funding at 80 basis points. That's our price right across the market. And whatever discount that means in terms of the difference between what they borrow at from us and what they could borrow from on the market, they must pass that discount on to the end user SME. So that's the lending side of the house. And we do that through about 7 or 8 different on lenders at the moment. Risk sharing is where, the whole access to finance piece is addressed really, because what it does is that it inserts a guarantee, a government guarantee or a European guarantee into a scheme, which takes away some of the risk from both the lending institution, but also from the SME. So by doing risk sharing, what we're trying to do is we're trying to get SMEs to see that they can borrow in a safer way than they did pre the financial crisis, when personal guarantees were the norm, when you actually tied all your assets into that personal guarantee and you paid the price at the end of it. So what we're trying to do now is we're trying to, I suppose, reinstill a degree of confidence in SMEs that they can borrow, but they can borrow in a way that they don't risk every single thing as they would have done in prior economic cycles. And the service provider piece is just that we operate the credit guarantee scheme on behalf of the government, but the new credit guarantee scheme, we do far more. So I'll get into the schemes in a minute now. Just to give you a sense, these were the last published figures, progress to mid-year 2020, 1.7 billion in funding put out there into the marketplace and 32,000 SMEs supported. I'd be delighted at this minute in time to say that we're up now over 2 billion in terms of funding out there in the market and nearly 38,000 SMEs supported. So you can see that like more than 1 in 8 SMEs in Ireland has availed of an SBCI facility. So it's beginning to be, much better known out there and much better accessed as well. To give you a sense around the left-hand side of this slide is the pure lending screen, which is our liquidity. This is our discounted lending put out there through the banks initially and then non-banks. Just over $1 billion gone out there in liquidity lending. And on the right-hand side, risk sharing, you can see at this stage that's 639 million. That's gone to nearer 1.1 billion at this point in time. So you can see that the shift is starting to go from left to right, from liquidity much more towards risk sharing. And that's a natural evolution in the marketplace. And that's what has actually happened in Europe over the last 50 or 100 years as well. So we will see more risk sharing taking place in Ireland. It may not necessarily be at the current rates at 80%. It could be less than that. It could be on a co-lending basis. There are a number of models that we're exploring as we go through the evolution of the SBCI. So these are our networks and our relationships. The ones that are most important here are on the left-hand side. You'll see our risk-sharing partners, which are AIB, Bank of Ireland, KBC, Linked Finance are new, PTSB are new, Ulster Bank, and we have 19 credit unions in there as well. So, that's a really new departure from the SBCI's viewpoint. We're making the finance available, particularly on the credit guarantee scheme, available through credit unions. And that has been actually very successful even in the last couple of weeks in terms of new business being written. On the right-hand side, you'll see our liquidity partners, and they are BIBI Financial Services, who do invoice financing, Capital Flow, Flexico Finance Ireland, and SME Finance and Leasing, a small company down in Carlow in Kilkenny, who do a lot of the small agri and yellow plant leasing. So we try to work through, obviously, the European Union institutions, the EIB, the EIF, and the EU Commission, and then we have the government departments and state agencies as well. So in terms of the funding supports available, short, medium, and long term is how I describe them. If you look at COVID-19 Working Capital Scheme and the Brexit Loan Scheme, they're built off the same platform. They're a short-term scheme, 3 years, 1 to 3 years, fixed rates on those, fixed rate, maximum 4%. And again, on these ones, we have unsecured lending up to €500,000. If you look at the bottom left, the Future Growth Loan Scheme, which has probably been our most popular scheme, that's the 7 to 10 year scheme. That's the long-term scheme. And that one actually has flown out the door to the extent that a lot of places are actually closed for applications. And I'll update you on that in a few minutes. And then on the right-hand side, you'll see the CGS, which is the Credit Guarantee Scheme, the original one, and the COVID-19 Credit Guarantee Scheme, which is the new and revised scheme. And this is the one where the government has effectively put a 2 billion guarantee in behind that particular scheme. and we're beginning to see real traction on that. And that's a medium-term scheme. That's loans up to 5.5 years. So just on the Brexit loan scheme and the COVID working capital scheme, loans between 25,000 and 1.5 million, maximum interest rate 4%, loans range from 1 to 3 years, and loans are unsecured up to 500,000 euros. So no personal guarantees, no additional security required. So what this has done is effectively it has brought down the interest rate, but it has also brought down the security requirements, and it has allowed SMEs that are viable to actually apply and get lending. We introduced that COVID working capital scheme within 2 weeks of the lockdown. So it was a very quick response. It's a 3-year scheme, and a lot of people borrowed under the COVID-19 working capital scheme and are now still closed. Anyone who has borrowed under that particular scheme is actually eligible to refinance that under the COVID-19 credit guarantee scheme, which means effectively taking the 3 years, the debt that has incurred on the COVID, and spreading it out over another 5.5 years. So that may be of some assistance to some SMEs who already have debt built up. So it can be used for future working capital or to fund innovation or change. And the criteria on this, it's the same right across all the schemes. You must be at least 15% negatively impacted your turnover or profit by Brexit or COVID-19. So the Future Growth Loan Scheme, I'm only literally going to flash on this one because effectively it has been so popular. It was launched as a 300 million scheme in 2019. 300 million was effectively fully utilized by December 2019. We got a top up of €500 million, which we launched in July 2020. And at this minute in time, we're looking at AIB, Bank of Ireland, and PTSB being fully closed. Ulster Bank have some capacity. KBC have some capacity on the scheme. And we're hoping to announce one more partner in the coming week, we hope, on this particular scheme. This has proven to be extremely popular. Initially, the scheme was out as loans between 100,000 and 3 million. Feedback from SMEs was that 100,000 was too high. They wanted it down to 25, so we brought the loan down to 25,000, range in terms from 7 to 10 years, and again, unsecured up to €500,000. And that money has actually flown out the door. That's really the investment scheme, and that's the one that has been our most popular scheme to date. For all these schemes, you have to apply to us first, because what we've done is we've tried to actually make the application process fairly straightforward. We are asking people to come to us first. We will give you an eligibility number, a code, which you will put with your credit application, which then goes to the bank. That is not a guarantee that you will get a positive decision from the bank. All it is saying is that you are eligible for this particular scheme. So don't misread that as being your sanction in principle. It's not. Just wanted to give you a sense around the progress on the schemes today, because there has been some comment around the low take up on the schemes. So if you look at the top two, Brexit loan scheme and COVID-19 working capital loan scheme, these were designed on the same structure, and it was a 300 million total funding for both of those schemes. And you can see at this point in time, there's actually nearly 190 million sanctioned on that scheme, and that's across 12 or 1300 SMEs. So effectively, more than 66% of that scheme is now out there with SMEs. If you look at the Future Growth Loan Scheme, the latest figures on that, we're now up to 624 million sanctioned, and the bulk of that is drawn. And that means that more than 3,000 SMEs have actually availed of long-term finance or investment capital finance for their business. If you then look at the COVID-19 credit guarantee scheme, which there was a lot of noise around about the low take up in the first 2 months, it's hard to expect SMEs to know what they want to borrow for, particularly if they're still in the middle of lockdown. However, as Tony was saying, a lot of them will have still had bills to pay during COVID, particularly if they're in rented premises. They may have had rent, they may have utilities, so any of the debt that's been built up there, and if they need funding then to reopen, that qualifies under the COVID-19 credit guarantee scheme. And you can see that to date, this isn't sanctioned money. This is money that's actually drawn by SMEs, and 157 million has been drawn, particularly since Christmas. That has actually increased week on week. And that means that nearly 3,000 SMEs have actually availed of this particular scheme. So overall, I suppose what I'm trying to say on this one is that the risk sharing piece is really, really important to us. The risk sharing scheme, I think, is really important to SMEs because it puts an 80% guarantee into the mix, and that's a government or EU guarantee. The 20% liability remains with the lending partner, and that can be either your local credit union, your local bank, linked finance, any of those providers. They take 20% of the risk. For loans up to 500,000 in the case of the Brexit loan scheme, COVID-19 working capital scheme, and the future growth loan scheme, no additional security can be requested by any of the providers under those schemes. In the COVID-19 credit guarantee scheme, the unsecured amount is €250,000, which is a first for the credit guarantee scheme. Loans in excess of that, the banks can ask for additional security. They can ask for personal guarantees, but it has to be, the personal guarantee can only be linked to the, it's to be used for the asset that is being taken, rather than necessarily a personal guarantee unsupported, which has been the tradition over the years. And effectively, the schemes to date, the average loan size has been more or less in line or below the unsecured amount. So SMEs have actually dealt with this in a very, I think, clever way, and they have availed of the finance. And I think it's really beginning to show that SMEs are beginning to develop a little more confidence around borrowing again. So the CGS scheme, it's 2 billion, as I said. There's plenty of capacity on that. We have effectively brought down even the loan amount on this one from 25,000 right down to 10,000. So facilities on this scheme range from 10,000 to 1 million. Terms from 3 months to 5.5 years, and facilities unsecured up to 250,000. And as I say, don't forget that there is the capacity on this scheme to refinance and roll over finance agreements that were done since COVID hit. Unfortunately, if something was pre-COVID, it can't be refinanced using the credit guarantee scheme. There is one exception, that if you apply for a new loan, 30% of the new loan can be used to finance debt that pre-existed COVID. So effectively, if you apply for a loan of €100,000, there's 30,000 of that new loan that could be used to pay off debt that was incurred pre-March 2020. So again, this is the credit guarantee scheme is open to micro SMEs, small mid caps, including primary producers. So this is open to agriculture and fishing as well. And again, it is turnover or profit negatively impacted by 15% as a minimum. Viable businesses, I think it was somebody was asking about eligibility on something I was on another call yesterday. We are saying that people who are financially viable on the 31st of December 2019, so that's if you have your accounts for 2019, you will be eligible for this scheme, as long as you can actually prove to your lending institution that your plan is sufficiently strong to actually get you out of the COVID and get you reopened in a profitable and viable way. So the loans can be used for working capital or investment and refinance short-term debt. Now, there's a couple of criteria around the credit guarantee scheme that just are worth mentioning. The maximum amount is €1 million. Okay, so and it's a one-off. You can't, if you get €1 million under this particular scheme, you can't come back for another €1 million, even if the scheme remains open. But what we've tried to do with the scheme is build it in a way that gives the SME the best possible chance of getting the best possible amount for their business. So what we're saying is that it can be double your annual wage bill for 2019. So if you have your figures in your accounts for 2019, then the wage bill in there is actually twice that amount is what you can be eligible for. Now, you still have to prove your payment capacity, but it's either that or 25% of your turnover in 2019, whichever is the greater. All right, so it's unusual in that case. So if your wage bill was 200,000, then double that would be 400,000. If your turnover was 2 million, then 25% of that would be 500,000. So you would be looking at number 2 in terms of the COVID credit guarantee scheme. The scheme costs, the rates on this are particularly good. They're sub 3% in most cases. The credit unions are offering rates of somewhere between 4 and 5.5%, which represents about a 4 or 5% discount on their normal lending. So it's a good value scheme, and it's as I say, 5.5-year money as well. And then there is a premium which is payable to the government, and that is just to offset the cost of the scheme. And I'll just give you an indication as to the type of interest rates or the premium rates that are applying here. So this is on top of the interest rate. So if you're looking at your typical 3-year loan, you'll be looking at an additional 0.29% per annum. As you get into the longer terms, you pay more. And if you're a small mid-cap, you pay more as well. If you're an SME, there's one set of premia. If you're a small mid-cap, it's more expensive, and it goes up to 1.55%. But to put that into monetary terms, if an SME borrowed 100,000 over 3 years, they pay 447 euros as a premium on top of their interest rate over the 3-year period. So it's not that significant. And if you looked at 91 or 92% of SME borrowing in Ireland is less than 100,000 euros. So, you know, the average cost in terms of premium is not prohibitive. In terms of the sectoral engagement around the scheme, you can see that all sectors have applied and are actually engaging in the scheme, from ag to accommodation and food services, professional and scientific services, manufacturing. Every single sector that we actually monitor has actually availed of this particular scheme. So in terms of just conclusions from my viewpoint, I just want to say, look, that we're continuing to develop products. Our commitment is to bring products out there that SMEs want. I think we're beginning to see where risk sharing plays a role in the Irish market. And I think it will continue to play a very important role in the development of the financial market as we go. We're committed to bringing more competition into the market. We were delighted to see the likes of Linked Finance sign up with us, Capital Flow, and then the credit unions to actually put their head above the parapet and start to do some risk sharing with us. That's a real step forward from our viewpoint. And really, I think, you know, if anybody wants any further information, quite happy to engage directly. You can follow us on Twitter, LinkedIn, and we have a YouTube channel as well. And my contact details are there. Probably best to get me an email at this stage, given the remote working, and I'll definitely come back to you. So, Brian, that's really it from me. Whistle Stop Tour. If anybody wants to ask anything or questions, quite happy to take them.
Thank you very much, John. Very interesting there, and I know there's a lot has been covered. The first question we've got in at the moment, ECB rates are in negative figures and have been for a long time.
Yeah.
Why are the loan rates as high as they are now?
Yeah, it's a couple of reasons. One, obviously, people will want to make a profit margin on it, which is fine. I mean, all financial institutions need to do that to remain viable as well. But the cost of capital is quite high in Ireland, and the risk capital is quite high in Ireland as well. The SME book attracts much more capital than your mortgage book does in terms of your reserve ratios. So the actual costs for a bank or a non-bank to provide SME lending in Ireland is actually much more expensive than it is across Europe. That's historic. It will rectify itself according as the older loan books start to pay off and new loan books emerge. And as well as that, you can see that the impact of an 80% government guarantee has had a huge impact on pricing. We haven't seen sub 3% rates in Ireland since, you know, in the last decade. And with the credit guarantee scheme, you're seeing that, and you're actively seeing it on the FGLS as well. So we are nearer what they call EU2 rates, which is everywhere except Germany, France, and the Netherlands. We're probably not going to get to EU1 rates in the short term, but we've made progress, significant progress in the last, particularly in the last 3 years, in bringing down those rates. Like on FGLS, Brian, it's worth saying that if you wanted to borrow 7 to 10 year money unsecured, if you could get it, you would be paying somewhere between 8 and 10% for that.
Okay.
And on FGLS, you're paying 3.5.
Thank you. Colin Duggan wanted to come in there.
Yeah, Tony, if I could ask you, with regard to tax warehousing, do you see that continuing into 2021, and would it remain probably while we're in level 4, level 5?
Yeah, I can't be wrong on this one, Colin, so it's a handy question. It's a view. All I can say is that the language out of government is all the schemes I discussed there, the current ones, in principle are to run to 31st March, so that the cash ones. The language in even the last 24 hours is that it's likely they will run to mid-year. There's an element from a government's perspective that if you're borrowing, you might as well cut for a sheep as a lamb, because they certainly don't want to damage the thing by getting negative on the supports. So to answer your question, I'd speculate that we'll continue rather than the opposite.
Okay, thanks a lot. And thank you for a fantastic presentation. And John as well.
Yeah, thank you. And Colin, I might add to that, just in the context of our own schemes, that credit guarantee scheme, which was originally due to expire in December, the temporary aid framework in the EU temporary aid framework was extended until the end of June and has subsequently been extended to the end of December. So we're waiting at the moment just in terms of a government decision on the credit guarantee scheme. But it's quite possible that it will be extended from June this year until December as well, you know, so everything just seems to be moving out slightly, you know. I'd follow Tony's view on that one, you know.
Yeah, and I suppose especially if we consider hospitality as an example, they really won't have a handle on their short-term future and to draw down whatever funds they require until really June, July, something like that.
But get it sanctioned, Colin. Don't wait around. You know, get it sanctioned. At least have it in the bag so you can draw it when you want to. You know, most banks will give you, you know, 3 months or 6 months of a letter of sanction that you can actually go back to, you know.
Yeah.
John, actually, next question just in for yourself. Can a future growth loan scheme be used to develop a site or property? Would not be our primary business, but would be something we're hoping to do in the near future. Turnover in the main business would be down due to COVID.
Yeah, the answer is no, unfortunately. It can be used to build a premises for yourself, for your own business, but not for anything else.
Okay, thank you for that. Is there any more questions, or does anybody else like to come in there on any points that have been covered in this afternoon session? I think there's been a lot of information covered, so if you do want to play back or look back on any of the information at all, the recording from today's session will be available on the Carlow Chamber website. That should be within the next 24 hours, so feel free to log on there and you can play back at any stage. I see actually just Michael Walsh. Michael.
Hi, guys, that's a great presentation, thank you. Can I just get I don't know if you can clarify this. The hotels, restaurants, cafes under COVID fixing level 3, are we still eligible for the CRSS if our revenue is down by over 75%? Can we clarify that? It came up with us through the Hotel Federation there back in November and December. We haven't really had anything on it yet. So would you know anything about that, Tony, possibly?
I wouldn't pretend more knowledge than the Hotel Federation on the issue. What's the question? Is the degree of restrictions?
Yeah.
I won't bluff you on it, Michael.
Okay, yeah. No, I just wondered, did anybody know anything more about it? We were all in level 3 during December. We weren't sure whether we could apply for it or not. So, thanks, anyway.
I know I was talking to Kieran about some of the tourism-specific supports and that as well before, and I know there's still further clarity needed on a few different areas. Is there anyone else there? Anything else we wanted to? But we'll have a look, and if I can get some more details on that, Michael, I'll come back to you as well on that. Okay. But I suppose for us there now, unless if you have any more questions, we'll start to wrap up today's session. But do check out there on the Leo website. There's 3 more lunch and learns available to book over the next coming weeks. The full details and that are there. Did you want to come in, Paul? Sorry.
Just John Madigan, if I could. John, just on people refinancing their debtors book, what way does that stand with different SCBI loans?
Yeah, the credit guarantee scheme is there. If those debtors, you know, have been incurred during the COVID, you know, since basically April, that debt has been built up, then absolutely, yeah, it can be used for that. That's the COVID-19 credit guarantee scheme. Okay.
Yeah, that's great. Thanks. That's great. Thanks for that, chat. Cheers.
Thank you very much, Paul. Okay, so I think that wraps it up for today. But if you've got any more questions and you want to follow up afterwards, feel free to get in touch with me at the Chamber, and I can link in with John and Tony, or there are the contact details there. If John's email address and Tony's is straightforward enough, you can get Tony at Tony Harney Chartered Accountants, just out on the Dublin Road. But for us, keep safe. Thank you very much for joining us, and we look forward to seeing you all again soon.
Thanks, Brian.
Bye bye.